You've seen those offers, 0% interest. And people rush and buy thinking, hey, free, cheap money. But then 24 months later, they don't have the money to pay it off, and the interest rates are sky high. And they weren't prepared for that. Well, companies have done the same things. They have piled on debts the world over while money was cheap. And now that money is coming due in an era where this money is now expensive. Economic uncertainty means you have to keep up with what's happening. Make sure you subscribe and we'll keep you in the know. Right now, large quantities of corporate debt need to be either paid off or refinanced. But debt refinanced today at the higher rates is a lot more expensive than when companies first took that debt on. And this could lead to the formation of a corporate debt cliff. Currently, U.S. corporate debt amounts to a jaw-dropping $13.7 trillion. And since 2020, U.S. businesses have expanded their debt loads by nearly 20%. Analysts say this high debt, higher rate environment is creating a corporate debt cliff, and companies that fall into it could bring the economy down with them. As the global head of restructuring at commercial bankruptcy law firm White & Case said recently, when interest rates are 1 or 2%, you can incur a lot of debt, and you can afford the debt service. When they go up to 5, 6, 7, 8, 9, 10%, things become more challenging. Signs of these increased pressures are evident already. Corporate debt defaults worldwide soared 80% in 2023. According to S&P Global Ratings, outside of the health crisis year of 2020, it was the highest default rate in 7 years. U.S. companies had an especially tough year, accounting for nearly 2/3 of all defaults in 2023. U.S. commercial bankruptcy filings were up nearly 20% overall last year, with Chapter 11 filings up 72%. The added stress of higher rates is contributing to a surge of corporate bankruptcies, which is out of sync with what is supposed to be a strong economy. As Bloomberg has noted, insolvencies normally spike once a recession is already underway. But businesses are collapsing even as labor markets and corporate profits show surprising resilience. And unfortunately, the story doesn't end here. The situation in the U.S. and abroad is poised to grow even more troublesome in 2024. In a recent report, S&P Global said, in 2024, we expect further credit deterioration globally, predominantly at the lower end of the rating scale, where close to 40% of issuers are at risk of downgrades. We expect financing costs to remain elevated despite the prospect of rate cuts. And the amount of corporate debt needing to be refinanced in the coming years is only going to rise from here. Last year's default trouble for U.S. companies came on the back of roughly $600 billion of maturing debt. That figure is projected to rise to nearly $800 billion this year, and according to Goldman Sachs, it will rise to $1 trillion per year from 2025 to 2028. Although it's not in the spotlight of the mainstream news, the escalating defaults and bankruptcy filings suggest a looming crisis, with 2024 ready to present even more challenges. As businesses grapple with the pressure, The road ahead remains uncertain, with the fate of the economy hanging in the balance. That's why I suggest you take the time to learn more about what's really going on in the economy by attending our exclusive one-on-one web conference at AugustaPreciousMetals.com/webconference.